I've heard it said that investing is a matter of an opinion, while taxes are a matter of certainty. There's some pretty big changes coming forth in the congressional legislation known as the One Big Beautiful Bill, especially for those that are focusing on retirement. And that is what we're going to unpack today. Hello, and welcome to another episode of the True Wealth Retirement Show. If we haven't met before, I'm Planner Mike, a certified financial planner and owner of True Wealth Financial. I believe that retirement should be prosperous, enjoyable, and purposeful. This is a show that's dedicated to helping Christians retire with confidence and clarity, so that they'll be freer to serve God and live the life that they truly desire. Thank you for taking the time to tune in today. Taxes. It's the thing we all love to hate. I don't know if you've heard or not, but the One Big Beautiful Bill is making its way through Congress. And this is a pretty massive bill. It's over 1,000 pages long. It's really a whole bunch of things rolled into one. It's a budget bill, it's tax legislation, and it has a whole bunch of things in there. It has passed the House back in May 22nd. It is currently working through the Senate in a revision with the goal of having it to the president by July 4th, which is good because a lot of times they pass legislation right at the end of the year and then it begins starting, soon thereafter. That's how they did the tax cut the first time when the TCJA was passed back in 2017. It started like 4 days later. So this will be nice because actually people have some time to plan about it. So today what I want to do is I want to give you 15 ways that this here could reduce your taxes as you progress towards retirement. Right. So as part of the True Wealth Total Retirement System, we always want to be reducing taxes because any dollar that we save from paying taxes, a dollar that we don't have to pay in taxes legally, that's a dollar that we have to spend, to give, and invest. And the reality is they add up over time, especially in retirement. Consider David and Lisa, who recently completed a True Wealth assessment. They found out that they had a total retirement tax bill of over $923,000. So it's easy to see why if we can save anything, it helps. And you might be surprised, as a retiree, you have a lot more control over how much you pay in taxes, certainly than you did when you were working, right? Because now you get to decide how much you take, from what pot of money you take it, how it's taxed, and so you get a lot more control. As you can see, the bill itself is over 1,000 pages long and it tackles a whole bunch of areas. The part that we're going to primarily focus on is Title 11. This is the part that comes from the Ways and Means Committee. That essentially is the primary tax writing committee in the House. So what I want to do here is I want to give you 15 ways that this bill will help Christian retirees reduce their future tax bill. All right, so first and foremost, what this does is this extends the current tax rates. Right, so the current law as it's set today is set to expire December 31st at the end of this year, which essentially means that every tax bracket that there is, except for the 10% tax bracket, is going to increase. That means essentially 99% of all Americans' taxes are going to go up January 1st if they don't pass this, which is why I think it's going to pass. This essentially will keep them constant. They'll stay at the exact same spot where they are. This is why you might have seen in Right Capital, the tax calibration has always had two rates for the last couple of years because we've always been assuming that the tax rates would expire. And what will really happen if there's any clients watching, what will happen is more than likely when we change that out, your percentage of success is going to go up by about 2% or so, give or take. Right? Because essentially, like say right now, you're in the 12% tax bracket. That in theory ends the end of the year. And then you're in the 15% tax bracket all going forward because we were assuming that it would sunset. So now all those future taxes will be reduced rate, which means you have more money. Probability of success is going to go higher. So great thing for you. Secondly, what this is going to do is going to keep the standard deduction. The standard deduction is the amount that you can make before you pay any taxes. It's really like tax bracket zero. You can think about that. So if it was to expire, we go back to the $8,300. But you can see by keeping the provision, we have over $16,300 for a single person and $32,600 for a married filing jointly paid. So essentially doubles the amount of money that you pay zero tax on, which again is very, very good for not just all Americans, but primarily for Christian retirees. The next one is that it does away with personal exemptions. So an exemption is the amount of money that you can essentially deduct from paying income on, reducing your taxable income. So they kind of worked hand in hand with that standard deduction, but essentially they got rid of them altogether and then they raised the standard deduction. Obviously, the more kids you'd have and the bigger family you'd have more personal deductions. So, it's generally good for families. But here's the nice thing. As a retiree, you're generally going to be an empty nester, right? So that if that were to come back, it really wouldn't help you. So we have more benefit by us not having the personal exemptions and the higher standard deduction. Another potential provision here is that the extension of the qualified business income or QBI deduction. QBI is a below the line deduction for small businesses and self-employed. Essentially, what it does is kind of makes the tax rates equivalent to those of the corporate rate. So what they were afraid of is a lot of people would go and just start corporations unnecessarily. A self-employed person start a corporation just to get a tax benefit. So they created a QBI deduction, essentially making a level playing field. And so under current law, this would go away. And here's the thing, right? It's not uncommon for a lot of retirees to maybe do some consulting or some part-time consulting as they transition into retirement. Not only are they trying to keep it in there, but they're actually trying to increase the rate to 23%. So 23% would be deductible, which means you don't pay tax on almost a quarter of your self-employed income. Another big one is AMT, alternative minimum tax. Now, you might not know this, but every tax return that's filed runs through this test called AMT. Essentially what it does is it runs through every return to see if you're paying your quote unquote fair share. It makes higher tax provisions for higher incomes and people, especially with stock options. If you don't have it, most people don't use AMT. The vast majority of people don't. The amount that have been during the last 7 years while this has been in place has actually decreased a lot more. But again, this is something that a lot of people would do as they're potentially approaching retirement. If they've had stock options for a long period of time and they're vested in them, they'll cash those out, which could throw them into AMT. So again, by this going away, this will help potential retirees. Another nice one to help a lot of people is no tax on overtime, right? So this is really good if you're trying to play catch up, trying to make a little extra money with that going into retirement savings. This is a great way to, one, make some extra money, and two, not get taxed on it, thereby giving you an additional boost. This one specifically is designed for seniors, which is enhanced deduction for seniors. So hard to remember, but pre-2018, essentially you just had the 1040, 1040A. Well, now there's a 1040 SR, stands for senior. Essentially, anyone who's over 65 years old gets an additional standard deduction. What they're proposing is raise it up to $4,000 per person, husband and wife. $8,000 essentially of additional standard deduction, right? So there is income limits. So $150,000 married filing jointly, 75 for single filers. But again, it's a great way to help get a bigger deduction for seniors. And it doesn't matter if you itemize or you don't itemize, you're going to get that. So essentially as a senior, 65 and older, potentially $4,000 to $8,000 of income taxed at 0%. Great benefit for seniors. Number 8 is the reinstatement of the partial deduction for charitable contributions. So you might remember around COVID time, there was a $300 above the line deduction for married filing jointly or $150 for single filers because less and less people itemized when this went into place the first time. And so there was an above the line where you could save a little bit of extra money. 2021, that was done away with during the Biden administration. And so now they're proposing it come back. And so again, for those who give, like most Christians do, a little bit of extra savings for your charitable deductions because most people don't itemize, so you don't get credit for that deduction anymore. This is something that's all new together, which is MAGA accounts. MAGA is not Make America Great Again, at least not in this regard. It is Money Accounts for Growth and Advancement. So this is a new kind of savings account. They could be used at any kind of bank or financial institution. It's meant to put money aside for education, entrepreneurship, or home ownership, really to promote financial security. So the nice thing about any child that was born after January 1st, 2024 would be eligible for this. It can be opened by parents or relatives, meaning grandparents can open this up on behalf. So it's kind of like a 529, but it's not just limited towards education. It can be used for future home ownership. So you can put money into this, have it invested, have it grow for your grandchildren to have essentially the ability to buy a first home with it. So Awesome idea there, MAGA accounts. So that's number 9. I have 6 more to go. But first, if you're finding this information helpful and valuable, do me a favor, please hit that like button. It'll let me know to do more shows like this. Plus, it's a nice way to say thank you. Okay, now a lot of these next ones have to do with health savings accounts. Health savings accounts are great. They allow for a triple tax advantage. Right? So health savings account is the idea that you put money into an account. It goes in tax deductible, so you don't pay tax going into it. It can grow tax deferred. You don't pay tax on it while it's growing. And you can take it out as long as it's used for qualified medical expenses. It is tax free, which, as a retiree, you're going to have potentially more medical expenses over time. And so this is a great way. It's like a Roth IRA for medical expenses, right? So this is great. I'll probably do a whole show on this sometime in the future, but there's a lot of more things that are coming towards these accounts, which are really, really good because you can use them now. You don't have to use them right away. You can put money in there while you're still working and then have it come out a little bit later on, 10, 20, 30 years, et cetera. All right, so the first one is that those on Medicare can contribute to an HSA. Under current law, people who are eligible for Medicare Part A, so generally 65 and older, they're ineligible to contribute to a health savings account, even if they're still on a high deductible healthcare plan. This provision will allow seniors who are working be on Medicare Part A and also enrolled in a high deductible healthcare plan and contribute to an HSA account just like they could pre-65. Additionally, it helps the exchange plans work with HSAs. So especially people who are looking to retire early, who are going to leave their employer and leave their health insurance behind, a great way to get insurance is through the exchanges, the state-run exchanges. Well, there's different levels in there, gold, silver, bronze, et cetera, et cetera. And some of the bronze and the catastrophic healthcare plans, basically, they disqualified you from using an HSA. And so this provision would essentially get rid of that. So you could use a healthcare option over here, bronze or catastrophic plan, and have an HSA account as well. This is something actually that I plan on doing at some point. The next one is gym memberships with HSA. So as a senior, maintaining and improving your health, it's a very, very big thing. And even more so from a longevity perspective, but also quality of life. And you have a lot more time, so you can actually go to the gym. But under current law, fitness expenses, gym memberships, they're not allowed to be used for health savings account qualified expenses. This provision would allow a person to have a gym membership and also be able to get instructional, training essentially for about either up to $500 or $1,000 and use as a qualifying medical expense on their HSA account. The next one allows spouses to make catch-up contributions to HSA. It's kind of a weird law, but after over 55 and older, if husband and wife both they wanted to make their catch-up contributions, they couldn't go to the same account. They had to go to 2 different accounts. So sometimes people had to open up account to get it. Well, now you can have it going into one account for husband and wife. So just something that makes things a little bit simpler regarding that law. Sometimes there's just weird things that takes place here. Another one, speaking of weird one, right, is the idea that you can use your flex savable account and health arrangement funds that you have excess capital, that those can go into an HSA. Under current law, individuals cannot transfer the money, the balances, into an HSA. Well, now you can convert that balances into an HSA upon enrolling in a health care plan that allows it. There's another special rule that's going into place that for certain medical expenses incurred before the establishment of an HSA, you can use those money. So under current law, you can't use money in an HSA until it's actually funded and the account is open and established. Well, now you can open an account, put money in it, and use it for expenses that were used or given from a date of service 60 days before the establishment of the account. And another one essentially is allowing you to put excess contributions into a health savings account. So under current law, there's limits, contribution limits that get inflated every year. So in 2025, it's $4,300 for a single person, $8,550 for a family. Well, this provision essentially will allow people making under $75,000 or $150 to contribute an additional $4,300 into these accounts. So there you have it. 15 different ways that this tax bill will help Christian retirees as they begin to focus on retirement and reduce their tax bill. As we conclude, if you're still with me, please consider subscribing. It'll help spread this information to others who might need it. And more importantly, you'll be notified of future episodes. Taxes are complicated, but solvable. If you too are interested in finding out what your total retirement tax bill will be, consider engaging in a True Wealth assessment. You can find the links in the description below. Today, we talked about taxes and the importance of taxes in retirement, and I give you 15 ways that the One Beautiful Bill might help reduce taxes in retirement. Hope this helps you on your path to a retirement that is prosperous, enjoyable, and purposeful. Till next time, hope you have a great day. God bless. Thanks again for taking the time to watch this week's episode of the True Wealth Financial Show. I encourage you to like, share, and subscribe so you don't miss any future episodes. Additionally, you can find more information on our website at www.truewealth.show. One final note, though, as we wrap up to today's show. While I hope the information was helpful, valuable, and insightful, it's really for information and educational purposes only. Prior to making any decisions or taking any actions, I'd strongly encourage you to talk to your legal, tax, estate, or financial advisor who's familiar with the unique circumstances of your particular personal situation. Thanks again for watching, and until next time, hope you have a great day.